Good afternoon, everybody, and welcome to our Index Universe webinar, Beyond the Expense Ratio, Uncovering the True Costs of ETFs. I'm Paul Amery. I'm the editor of indexuniverse.eu and the Journal of Indexes Europe, and I'm joined on today's webinar by Ed Moisson, who's head of UK and cross-border research at Lipper, by Peter Sleep, who's senior portfolio manager at Seven Investment Management, and by Len Welter, Chief Technology Officer at Data Explorers. A reminder to all of you listening in that you can submit a question at any time during the next hour. All you have to do is to type in your question in the Q&A box, which you'll see at the lower right-hand corner of your screen, and click the send button. For the first half an hour of the webinar, we'll be making some presentations, and the second half hour we'll be running through the questions, and I'll be presenting them to our panelists. But you can send your questions in at any time, and we'll collate them and pass them on at that point. And with that, I'm going to hand over to Ed for his presentation, and I will be back in 15 minutes.
Thanks very much, Paul. Okay, so just a little bit of context. So I work at Lipper, where we do mutual fund research generally, and that's what a lot of the slides that I'm going to talk to this afternoon relate to, not ETF specifically, but sort of wider industry context as well. And with that in mind, I thought I would start by defining the terms that we currently have in the wider industry of the total expense ratio, which I would define as the drag on fund performance caused by all annual operating costs, assuming a portfolio is held and not traded. Now, within that, often the question is asked, well, what exactly goes into that? And already, straight out of the blocks, we're into a bit of a thorny issue because disclosure does vary a lot around Europe. But when Lipper calculates total expense ratios, we look at fund report and accounts, and these are some of the key constituents that make up the TER. Obviously, whether or not they're disclosed, these are some of the key elements which fund managers are having to, or services which they're having to pay for. Obviously, the main element being investment management, but also the back office costs of administration, custody, depository, and trustees, I suppose, fit all into a similar sort of bucket. Professional fees, audit and legal. We do come across instances, particularly when we're looking at the Luxembourg and Irish funds being sold cross-border, of expenses, other ranges of expenses appearing, such as printing and publishing, marketing type expenses, directors, and so on. Taxe d'abonnement is a specific Luxembourg tax. Distribution fees, the disclosure of these for actively managed funds is sort of a hot topic as well, commonly not disclosed in fund report and accounts, but if they are, then that would also form part of the, it anyway forms part of the total expense ratio, what is commonly known in the UK as trail commission. And generally in accounts as well, you would then see a sort of a bundle of other fees, miscellaneous or whatever. I've also added in performance-related fees here, as I'll touch in a moment. The treatment of this varies depending on, people have different views on whether a performance-related fee or the effect of a performance-related fee should be included in the TER or not. But it's certainly an expense that one can account for and see its impact over the past year. Now, some of the sort of rationales and thinking behind the use of the total expense ratio, I think, I suppose, as I've sort of alluded to already, from my experience working at Lipper, we do independent calculations. So we dig out the fund report and accounts and troll through to find out what has been charged to the fund. But as I mentioned already, there isn't a consistency of the way that fees are broken down, expenses are broken down in accounts, but that doesn't mean that the TER itself isn't a consistent measure of what I would call operating expenses. Obviously, because we're in an ETF environment, it's worth noting when you look at the fund accounts for an ETF, generally there is just, as far as the operating expenses are concerned, there's just one line item of operational expenses or management expenses, and from that, most of the time, all of the expenses which make up the TER are also formed, so that generally what would be seen as a management fee is equivalent to the TER as well. That varies, but generally it's the case. I think one of the key elements for a total expense ratio is that for a long-term investor, and again, I'm thinking of the wider mutual funds industry as a whole as well, it enables one to have a long-term view on what the likely cost impact will be, not just in one year, but in each year, particularly over the longer term, the drag effect, as I mentioned, of charges over the longer term. Obviously, the TER can vary, but as long as there aren't significant changes, most notably in management fees, then one can assume, or it's reasonable to assume that the impact will be equivalent each year, or not radically changing each year. Specifically, I referred to the issue of the portfolio not being traded, and so costs, in principle, the costs related to the activities of the fund manager aren't reflected in the TER, so trading-related costs. But within the terms which we've defined here, enables consistent comparisons across funds. I thought it would be interesting to include a slide here, which previously we'd done some work for INREV, which is the Institutional Investors Association for Real Estate Funds, obviously not directly relevant for ETFs, but some of their rationale for trying to put in place specific metrics so that total expense ratios could be compared were here so that you would have two perspectives. One of an asset allocator's point of view, where it is useful to see the relative costs on a consistent basis between, say, an equity fund, a bond fund, and a real estate fund, and a different perspective for someone having taken the decision to invest in a real estate fund, so investing into real property ultimately, would be to drill down and see not just the operational costs of the fund, but also costs related to the management of properties themselves. It opens a whole other question of how one gets to grips with those issues, but you can see that already for other institutional investors, this sort of dual perspective has already been put in place, and I think it's worth bearing in mind that it's not just a question of what you are or aren't including in the cost figure, but your perspective on why you're looking at these things in the first place. As to regulations, as to sort of how we've got to the situation we have, currently the total expense ratio is required in the simplified, or maybe one should say the so-called simplified prospectus, which is governed under UCITS 3 rules. Soon that will be altered to what is called the ongoing charges, which is required in the key investor information document underneath UCITS 4. The main reason for the change in the name is to do with this issue about the total expense ratio, having the word total in it, and the regulators being concerned that quite how total is it. And I think that's something which we're going to touch on later. It's interesting to note that during those discussions, CSER, or what is now known as ESMA, during the discussions for UCITS 4 and the KIID, the specific issue of trading-related costs was raised, but at that stage, agreement couldn't be found on how it would be possible to include those in a cost figure or to show it as a separate cost figure on a consistent basis across not just equity funds but across different asset classes. So there is some desire to disclose that, and obviously the ETF industry is another dimension which puts pressure in that area. I think it's worth noting that clearly, as UCITS have evolved, they're certainly not exclusively retail products, but it's worth bearing in mind that I think at its heart, UCITS originally, when the regulators imagine the end investor, it is generally a retail investor that they have in mind, and therefore the way that disclosure is developed and presented is with that same investor in mind. Having to deal with an unsophisticated investor, I suppose. On other regulations, it's worth noting both a UK-specific regulation, the Retail Distribution Review, and an international regulation on MiFID II, where the way that services for advice or for distribution are being scrutinized, and rules as to the way you can charge for that are being changed. And obviously that will have an impact on the levels of fees which the TER captures, and also the way that the end investor sees those costs applied to their investments. As for the future, obviously the regulation to look out for relates to PRIPS, the packaged retail investment products, where where there's a desire for the regulator to be looking not just at mutual funds, but across the range of financial products and try and get some consistency there, obviously one element of which would relate to costs. It's maybe worth then putting that into a sort of a broader context, and here I draw on a study we previously put together where we're comparing the total expense ratios specifically on actively managed equity funds, and I've included both a straight mean TER, so this is both what a simple average, as well as an asset-weighted average, so that a greater emphasis is placed on larger funds where there are greater assets. And here I've included cross-border funds, so funds sold into multiple jurisdictions around Europe, funds domiciled in the UK, and funds domiciled in the United States. And we can see not just the relative levels of fees between these different countries, but also the differing impact of economies of scale, of larger funds having bearing different costs, most notably in the United States, where management fees in particular vary depending on the size of funds. It's worth, I guess as a footnote, it's worth saying that in one slide I can't really summarize the range of different issues impacting on these findings, but economies of scale are relevant. I think also relevant are just the sheer size of some of the largest funds in the United States, which are much larger than one would find in Europe. And the way that investors buy mutual funds does vary considerably, not just across Europe, but also in the US, where long-term investors are often using mutual funds through retirement plans, which has a significant impact. For this presentation, I also then added in how ETFs within Europe, so this is a Europe-specific figure, but again, equity-based ETFs fit into the comparison as well. And again, you can see not just how the average is different, but also how the lower costs on the larger funds, which tend to be more mainstream indices, are lower as well. So it provides a little more context. A little more context can also be provided by including, again, we're looking at mutual funds, but just looking at institutional share classes, so that effectively we're getting closer to what one might call factory gate pricing, or trying to strip out the cost of distribution. And you can see there how on average the fees come closer to around the 1% mark, and obviously that does vary depending on which jurisdiction we're looking at. So that gives a little bit more flavor. I think particularly with an ETF in mind, then having some institutional level fees for actively managed is useful. However, still on the retail side for actively managed funds, the trends that we have seen, because of these different factors of distribution, of cost sensitivity, and of the way that investors are persuaded by this performance story, the trend that we've generally seen over time is of rising management fees and of total expense ratios since coming down in the second half of the last decade, generally rising through this decade. And it's even if the picture is slowing, it is a story which continues to unfold in this direction. This is the cross-border universe of funds. I'll be quick here. I think sometimes there's an assumption that active fund managers will begin to lower their fees in order specifically to compete with ETFs. I think it's worth bearing in mind that fees for institutional investors are not just lower, as we've already seen, but also in the cross-border arena are falling. And that's not a new phenomenon. That is something that we've seen over time. And that cost-sensitive retail investors are generally much more likely to be choosing passive funds in the first place rather than actively managed funds. So there's much less cost pressure, downward cost pressure, from retail investors on the active side. And what we see, again, in the actively managed arena of funds being sold to retail investors is where non-price competition dominates, rather than fees determining or fees being a determining factor, enough of a determining factor for investors selecting funds. The knock-on effect of this, I think, is to be aware of different dynamics within the industry. So that whereas for food supermarkets, one might find that supermarkets do compete on price in a significant way. So I've included some names here sitting in the UK. But completely the opposite happens in the European funds industry, that generally one competes on other factors rather than on price in order to attract investors within the actively managed space. But looking not just on the distribution side, but on the production side, what one does see is that pricing pressure that food supermarkets can put on farmers reflects the type of products that they're being sold, so that a supermarket isn't delivering a service, as it were, it's delivering a product such as milk. And I think this is an interesting way in which ETFs could be interacting with the wider industry, is the fact that ETFs could be seen as commoditizing the funds industry as a whole. Although again, a caveat with the institutional dimension, that just as in farming, while institutions might buy commodities direct, retail consumers often go through a third party, be it Sainsbury's or Tesco's, or in the case of mutual funds, through an independent advisor. And just to round things off, obviously this isn't to say that that we can see a correlation between the money moving into ETFs and the level of fees. So that this is a simple chart looking at the assets invested into some of the largest Euro Stoxx 50 ETFs. These are the grey bars showing their relative sizes and their total expense ratios. We can see there isn't a simple correlation between the two. And I had included a slide on some ideas on enhancing cost disclosure. I'll maybe, in the interest of time, I'll maybe just leave that there. And I think these are the sorts of topics which are going to be picked up in the slides and then in the discussion which follows. So I'll pass it back to Paul.
Thank you very much, Ed. I'd like to carry on from your discussion and focus specifically on ETFs and how one might go about measuring their costs against the background of what you've just said. It's interesting that the significant discrepancy between ETFs and actively managed funds in terms of total expense ratios, and I found your comments on the different commercial models and the comparison with supermarkets an interesting one that we can pick up in the discussion. But let's look specifically at ETFs and what costs might be involved in these types of funds. Well, I mean, Ed, you've already hinted at this, but there's some rhetorical questions here. Is the total expense ratio really total, or in some other people might say all-in fees? Well, are they really all-in? Let's have a look at the evidence from the ETF market. What we've got here is the performance of a range of Euro Stoxx 50 ETFs, trackers of the Euro Stoxx 50 index, which Ed also just referred to and pointed out that there wasn't an apparent correlation between fund size and the total expense ratios of those funds. Here we're looking at their tracking performance over 2 years, 2010 and 2011. Just to explain what the chart represents, the lines are the tracking of the individual ETFs against the net total return version of the Euro Stoxx 50 index. That means the net total return version includes or accounts for some deductions for withholding taxes from the underlying companies, 50 companies in the index. Also for comparison, the black line, which you'll see at the top of the chart, is the gross total return index from stock. So the difference between the black line and the x-axis is effectively the difference that's due to the dividend withholding tax deductions calculated by the index provider stocks. And you can see that over the course of 2 years, the difference between the gross and the net versions of the index is about 1.75%. So we're looking at about 80 to 90 basis points a year of difference as a result of the different versions of the index. Now, what's interesting, I think, to note is that the tracking performance of the ETFs, if I can call it tracking, is so diverse. You've got let's say 1% a year tracking difference between the highest and lowest performing fund. And remember that these performance figures are based upon fund net asset values, which have already had a deduction for the total expense ratio. So these are effectively post-fee performances of the individual ETFs. And it's around 1% a year between the highest and lowest performing fund. And so you've got a significantly greater difference in ETFs tracking than can be accounted for by differences in total expense ratio. Well, in fact, this chart shows that, as I said, the chart shows performance post-TER, so one might expect to see no differences at all. Now, I think many people will be familiar for some of the reasons for these differences, but they're largely due to differences in the tax rates that can be achieved in practice by funds in different domiciles. Come on to that in a second. But it's also interesting to note that the one fund in Ed's comparison, that's the Deutsche Bank DB X-Trackers ETF, which has a 0 TER, is not the best performer. And it's worth mentioning for comparison that the range of total expense ratios on these funds is between 0 and 35 basis points a year. That's only a third of the maximum post-fee tracking difference. So there's some components in return that are much more important than the total expense ratio. Here we've done the same comparison for the Msci emerging markets net total return index and several European ETFs that track it. Again, we've got in the black line at the top of the chart the gross total return index, which over a couple of years has added not so much by comparison with the Eurostoxx 50. There's about 50 or 60 basis points in additional performance if you receive dividends gross rather than net. But over the 2-year period, you can see that the worst performer, the green line, which is a Lixor fund, underperformed the net total return index by about 3%. And just for comparison, the total expense ratio on that fund is 65 basis points. So 1.5% in tracking difference as a result of factors that are not reflected in the TER. Again, those costs, I think we can call them, are more important than the total expense ratio. And a third index, the S&P 500, again, net total return index is the x-axis. The gross total return index is the black line at the top of the chart. The difference is about 75 basis points a year between the net and the gross versions of the index. The net index assumes that 30% of the income from US companies is deducted, and so that's equates to an average 2.5% gross yield roughly on that index over the last couple of years. But here it's interesting to note that some funds do better than the net total return index, so they're obviously able to do better in practice than have a 30% tax deduction. That's clear from the Credit Suisse fund, but it's also interesting to note the change in performance in the DB X-Trackers fund from its introduction early in 2010. It started to underperform the net total return index, but then from late 2010, it started to pick up. So I haven't found the reasons for that particular performance, but it seems to suggest a change in policy by the manager. And how these changes in tracking come about, we'll look at now. Well, what impacts the post-total expense ratio tracking of different ETFs? In physically replicated ETFs, there can be a variety of factors that cause this: trading costs, different types of tax on the underlying activities of the fund, such as stamp duty or, in some markets, capital controls. There can be a cash drag between income received by the fund and the income assumption of the index. As we've highlighted already, there can be some important differences in the dividend treatment between the fund and the index. And securities lending can also affect tracking in a positive way, because that can generate significant extra revenues for the fund. And in synthetic or derivatives-based ETFs, all the above factors are embedded in the pricing of the swap that gives the index return to the fund. Well, those can be. Let's turn to synthetic ETFs in detail now and have a quick look at how that works. Well, what are the swap spreads that can give that difference in tracking performance to the fund? Well, what are commonly termed swap spreads can in fact be either a cost or a benefit to the ETF vis-a-vis the index return relative to the actual benchmark that the fund sets itself. And what determines the spread, primarily it's determined by what's in the substitute basket or collateral basket as opposed to what's in the index, and also importantly what's the level of achievable dividend rate in the market, sometimes referred to as the market dividend level, as opposed to the dividend tax assumption that's inbuilt into the index, and that tends to be typically the most pessimistic assumption So those dividend differences can lead to some differences in performance. Let's look in a bit more detail at the components of the swap pricing. In practice, the swap spread is calculated as two major components. One is the difference between what are termed the repo rates between on the index basket, in other words, the basket of stocks or bonds that the ETF is tracking, and the repo rate on the basket of assets that the fund is either holding or owning as a substitute basket or being pledged in the case of collateral. And there can be some differences in the repo rates on those two baskets of securities. And by repo rate, we mean effectively the rate at which you can obtain a loan using that basket of stocks as your collateral. In other words, it's a form of secured loan, and the repo rate reflects primarily the quality of the assets you're giving your counterparty as security. And the other major component of the swap spread is as we've described, difference between the index dividend level, which tends to be a pessimistic assumption, and what can be achieved in the market through the market dividend level. And both these components are constantly changing. They're variable components, and so the swap spread itself varies over time. As we define it here, a negative swap spread as a result of this calculation effectively means a gain to the fund with respect to the index performance, whereas a positive swap spread represents a cost to the fund with respect to the index. There are other details of the swap pricing, such as the swap term, its frequency of payment and reset, and any termination clauses that can also affect the actual pricing of the swap. Let's give some examples. Well, in the first example, let's imagine that a fund's substitute or collateral basket holds European equities, but the fund itself is tracking an emerging market equity index. And in this particular case, the example we're describing doesn't always have to be the case, but I think this has been common practice recently. So the repo rate on the index basket is higher than the repo rate on the substitute basket. That leads to a positive component to the swap spread, and that means the swap counterparty charges the ETF issuer a cost, and that could lead to some additional underperformance post-TER. In the second case, in the second example, let's say the fund holds low-rated or high-risk European sovereign debt, but it's tracking an index of higher-rated sovereign bonds. In this case, the sum of the repo rates may work in the opposite direction. In other words, the repo rate on the substitute basket may be higher than on the index basket, giving a negative overall component to the swap spread. And in this case, the fund, I put outperforms in brackets because it's clearly not real outperformance, but it's a reflection of some technical aspects of the securities finance market and the differences in holdings between the collateral baskets and the index, but that can lead to some excess performance by the fund against its benchmark. And looking at dividends in the third example, let's say the index dividend rate is assumed to be 70% of the gross rate, as is the case in the S&P Net Total Return Index. But in practice, issuers can receive 85% of the dividends. Well, there the swap counterparty pays some benefit to the ETF issuer, and the fund can outperform. Now, note I've said that the benefit or the cost is charged to the ETF issuer. There is no obligation on the issuer to pass such cost savings or charges onto the fund, and so there's a large element of discretion here, and how this actually gets reflected in the fund's performance is largely a matter of policy at the individual issuers. And one can guess that some of the differences in tracking are due to differences in policy here. There may also be down to differences in fund structure and fund domicile, but this is something that's worth checking with individual ETF issuers. Now, some of the European ETF providers publish swap spreads on their websites, and iShares does for some of its swap-based funds. In this case, we've taken its two emerging market equity trackers, and you can see that there's been some variation in the swap spreads charged by its counterparties on the Msci Russia fund and the Indian S&P CNX Nifty tracker. And for the Indian fund, the swap spread has varied over the last couple of years between positive and negative territory, and most recently has been a net benefit to the fund. We've actually reversed the figures found on the iShares website to be consistent with the framework we set out earlier. But a negative swap spread in this chart represents an actual outperformance of the fund with respect to its index. But the key point here is that these are market rates. iShares is working with a range of third parties here, and you can see that there's some variability in this particular component of funds performance. Well, how to compare funds on a like-for-like basis? I think there are, as we've shown in the calculation earlier, there are four principal components to the swap spreads. Those are the repo rates on the index itself and the substitute basket, and also the assumed dividend rates on the index and in the securities finance market. Only one of those figures, unfortunately, which is the index dividend level, because you can find that out on the index provider's website, is directly observable. It's also important to point out that better tracking after fund fees could reflect a number of things. It could reflect a greater tax efficiency of one structure by comparison with another, but it could also represent something that's less welcome to investors. It could represent some compromise on collateral quality or types of investment activity being undertaken. And there could also be some cross-subsidization by issuers, particularly in so-called vertical structures. In other words, the issuer could make a decision to give better tracking to an investor or charge a lower or even zero TER, but just to make, in the knowledge that they might be able to make money back on trading ETFs with their investors. And as I mentioned earlier, there's important question: does the issuer pass on all benefits from the ETF structure to the investor? And that applies equally to physical ETFs that are involved in securities lending, as it does to synthetic ETFs. And the cost question doesn't really end with the fund structure. Other things to consider are potential index costs. So clearly, if you build an index that has greater embedded costs and then say you do a better job tracking it, that doesn't really help the investors. So it's important to look at how the index is put together and whether there are any embedded costs in the index. The dividend tax assumption, as we've already mentioned, is in the index itself is an important thing for investors to check. There can be rebalancing costs when the index rebalances. Sometimes those are reflected in an explicit charge. At other times, they are inbuilt into the swap spread. And there's been some academic work on what's called the index premium. In other words, what the effect of holding a particular index means in terms of the let's say the rebalancing costs on the underlying index components. In other words, what happens to components coming into that index and what happens in price-wise to components that are leaving, and what that might mean for the investor tracking that index as opposed to a neutral position. There's an interesting paper on that by Petayisto, which came out last year. So just to summarize, there may be some, as Ed has pointed out, the KIID under UCITS 4 is going to require disclosure of ongoing charges, either in addition to the TER or as perhaps a fuller total reflection of costs to the end investor than the TER itself. And this should help throw some additional light on non-total expense ratio costs, perhaps of the type that we've just described. But it's unclear how, for example, I've already mentioned that things like differences in collateral quality between the index and the basket of stocks a fund is holding, or the basket of collateral taking in securities lending transactions, can also have an impact on performance and thereby on effectively the total cost of ownership of investors. And it's unclear how such differences in collateral quality might be reported under the new regulatory framework. And so we've ended really with a kind of an open-ended comment. I think given that the structural differences between different types of funds, achieving a true like-for-like comparison between different ETFs is going to remain quite difficult. So that brings us on to the question and answer part of the webinar, and I'd like to remind everyone listening in that you can send in your questions at any point, and I will address them to our panelists. But perhaps Ed, Len, and Peter, if you could unmute yourselves, we can move on to the Q&A. Peter, let me start with you. Yeah. referring specifically to ETFs, I mean, how important is this, let's say, post-total expense ratio tracking of different ETFs, and how much attention do you pay to that as part of your overall decision-making process on whether to choose a particular fund?
Well, it's key. I think what you've shown is how the ETF providers make money. Those that don't pay in the enhancements from stock lending or dividend arbitrage retain quite a lot of the value of an ETF, and those that pay it back in track better, and you do better as well. We look at that very carefully, and we try and capture those enhancements that are there to be made.
But I mean, is it then, would that then lead you to select the fund that has the highest post-TER performance? In the case of the Eurostoxx 50 funds, we saw that there was one fund, I think it was the ETF Lab fund, that is right up there, tracking pretty much in line with the growth. Would you therefore go for the best performer? Or does
I wouldn't go for the ETF Lab one. Because, again, you have to bear in mind your own personal tax position as a UK investor. That's a German domestic fund and doesn't have UK reporting status.
Okay.
And the reason it enjoys such good tracking is because it's German domestic and doesn't suffer withholding tax.
Right.
And therefore performs very, 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 very well. I would have to go for one of the Luxembourg or Irish funds. Okay. And there, I think it's reasonably clear that I think the DB UK1, the iShare UK1 perform well because they pass on those enhancements.
Okay. Ed, perhaps I could return to you, and we've tried to put ETFs in the context of the broader trends in the funds market, and on a headline basis, at least, by comparing TERs, ETFs are something like a quarter of the price of the average, or fifth of the price of the average actively managed actively managed equity fund in Europe. But what do these their complexities really of the ETF market make you think about the positioning of ETFs against the rest of the funds industry?
I do think, as far as retail investors are concerned, I think the first step is for them to be taking a decision on whether they want to be, were they more persuaded by the argument for active fund management or for aiming to track an index. I think the complexity of ETFs only comes once you've taken that first step. If you're deciding that, either I don't think active managers can outperform in general or in specific markets, then you'll be trying to get to grips with exactly how ETFs work and whether you'd be using a traditional index tracking fund instead. I think it is an issue. Complexity, be it in ETF or other financial products, is obviously problematic for someone that is trying to look across a wide range of products. I mean, be it sitting in the UK with, I don't know, sort of 2,500 mutual funds to be looking at. Or at a European basis, we're looking at 35,000 mutual funds. So, I mean, it's
right.
Anything that's going to make it more complicated views to be able to do consistent comparisons is going to be a challenge.
And could you comment? We have a question from one of the listeners about the situation on a global basis. You've mentioned the move under UCITS 4 and the KIID to disclose ongoing charges. What's happening on a global basis? Is there any consistency in approach if you look at, say, European funds against US funds or funds in other parts of the world?
The way that costs are disclosed will vary, but the total expense ratio, I mean, yes, you can get, I suppose it's possible that you would have differences, but in principle, as the total expense ratio should reflect, the annual operating expenses of the fund, you should be able to get consistency. I think that's perfectly possible, and, for the purposes of our comparison that I've included, we have it there. That doesn't mean that even then you've still got some issues such as performance-related fees where there are still some issues to deal with. But I mean, there is no global regulatory body on fee disclosure, as it were. So yeah, there's no rules governing it.
Yeah. Okay. Thank you, Len. Could I turn to you? I pointed out a little bit earlier that the swap spread has got 4 major components for ETFs. There's the repo rates on the index basket and the collateral or substitute basket, and also the market dividend level as opposed to the index dividend level. So as far as I know, only one of those components is directly obtainable by by searching on the internet, for example. Now, how can investors find out the other 3 components of that swap spread?
It's a good question, and I really don't think this is the right venue for me to do a sales pitch for the services of data explorers. But unfortunately, a lot of the sort of
a leading question.
Yeah, exactly. The securities lending. Paul, I'll buy a beer. I'll buy a beer later. Actually,
get to Data Explorer's subscription. I mean, I'm thinking.
Yeah, exactly. I think in broader, I guess just some general rule of thumb in terms of the marketplace, a lot of the what I would call the plain vanilla sort of indices, so the main markets, like the CACs or the FTSEs, they're going to be fairly low cost in terms of repo or securities lending because everyone's got those and the demand to borrow those for short selling is pretty low. Where it gets to be more interesting is where you get into some of the more esoteric type ETFs. That could be either some form of small cap index or an emerging market type index where the people who want to sell short either for hedging or for directional purposes on the underlying names, they're going to be looking to borrow those underlying names, and the supply is going to be relatively difficult. That's where I think the ETFs who track those indices have got a degree of pricing power, and that's where they can probably gain, in terms of what you pointed out, the beat the TER by actually lending it out because it's being priced up by the short sellers. In general, though, what I would say, if it's a main market type ETF, very unlikely that they're going to be gaining anything out of the securities lending revenue. And one thing, I don't tend to look at the swap-based market that closely, but this is more of a question, I guess, for you, Paul. If you are seeing funds or ETFs rather that are, say, outperforming the costs, is that, tracking a main market? I'd be kind of curious to see, well, exactly how are they doing that? Are they substituting a basket in some sort of way that isn't necessarily tracking the index, and does that open up the fund to any sorts of risks?
Yeah, as far as I understand it, the main differences in performance are to do with simple differences in achievable dividend rates as a result of fund domicile and let's say unnecessarily pessimistic in dividend assumptions by the index compilers or the sorry, I should say that they're benchmarks that the issuers have asked the index compilers to use. So I think that's a significant factor in explaining the performance for some of the ETFs. But as we tried to highlight earlier, there can be some other important factors, and the differences in collateral quality between what the fund is supposed to be tracking, in other words, the index basket, and what it's actually holding on a day-to-day basis can be another important element. And we've seen a trend towards greater disclosure of what the funds are actually holding on a day-to-day basis, particularly from the synthetic ETF providers. But it's still, even with that information, I can go on most of the swap-based issuers' websites today and see what they're actually holding. But it doesn't help me to find out what the economic benefits either way might be and how to evaluate that. So I think in broader terms, how might this be resolved? Are we going to get there through some centralized pricing of the securities loan market, or is there some way that this can be? I know that you track it and you do it on a commercial basis, but are regulators going to push for greater disclosure in this area and try and get this to be priced more openly, effectively, because it's a bilateral market, isn't it?
Mm-hmm. Well, it's an OTC market, so I think that's where it's a non-screen based market for the most part. So trying to get some sort of market price out, that is quite difficult. I think it could be down to the individual ETF providers to publish some of the blended costs, and I believe iShares does that in some of their literature. But in terms of a single point where any investor can go say, well, what's this basket worth. As far as I'm aware, there's nothing publicly available to that. I guess the only thing that I was saying before, if it's in a main market index, it's going to be it's going to be general collateral, which will be relatively cheap, as opposed to something that's going to be maybe on the mids and the small caps and the emerging space, which will be significantly more expensive, provided that there is sufficient demand, and that's something else that's not available in the market in terms of what actually is in demand in the securities lending space, which in turn represents what's in demand by the short sellers.
Oh, okay, so there's effectively a chain of factors that could be influencing what the ETF gets and how it's effectively going to track as a result.
Correct, and that's where I think one of the main points, and there's a couple things that are involved in this. The ETF provider themselves, when they're lending, basically just because they're sitting on the assets doesn't mean that everyone's going to take it from them. There is going to be that element of, well, are the stocks they're holding, are they in demand from the wider securities lending community who, in general, are acting on behalf of short sellers in the market. If there is no demand for whatever assets they're holding, then there's going to be no revenue generated from the securities lending component, which means they could then end up putting that into their GC baskets. But again, that's going to be something that's not exactly attractive to the wider market. So the returns they're going to get are going to be relatively low.
Okay. Thanks for clarifying that. I mean, Ed, perhaps I could return to you. We've got another question from the audience about what are these ongoing charges in the KIID document really going to be? Will they include, will they definitely include trading costs? And how specifically do you expect that ongoing charge calculation to differ from the current TER measure of costs?
In principle, the main reason for the change is to do with the name itself. It was this concern to do with, well, exactly the issue that you mentioned, the total within total expense ratio, and the ongoing charges was deemed to be a more easily understandable name for what was being disclosed. So I'd say that is the main difference. The biggest cost difference is likely to be on performance-related fees. Previously, under UCITS 3, the TER should include a performance-related fee if it was charged. So obviously not the structure, but just how much happened to have been charged last year, and then shown separately. Whereas now with the ongoing charges, that's not going to be the case. So you would not see performance-related fees included in the TER. It would have to be disclosed separately, and the structure should be disclosed separately. Specifically on trading-related costs, the quick answer is no. That's not going to be captured. The language isn't, I have to say, particularly clear, but my understanding is that it's being interpreted to say that previously some custody-related transaction costs, which were previously excluded from the TER, should now be included in ongoing charges. But it's really not getting to grips with the big trading, manager-related trading activity costs that we sort of thinking about here. It's not grappling with that. It's much more of a sort of anyway, for a retail investor, it's much more of a footnote sort of issue.
Okay, and will the way that the ongoing charges are described be down to national regulators to decide, or will this be something that's ESMA standardizes?
Yeah, I mean, there's a standard two-page layout. I mean, I think there's room for some flexibility on the way you brand it, but it's it's a pretty packed 2 pages, so the flexibility is pretty limited.
Right.
And I guess these things work. Normally, the guidelines are set down, and then I suppose it has to be adopted on a national basis. But I mean, as to the way it looks, there shouldn't be variation.
Yeah, Peter, can I come back to you? You talked earlier that you're obviously I think your choice of funds is partly dictated by where you're based and where your funds are based, and which funds might be which ETFs might be suitable. But we've seen some significant improvements in disclosure by ETF issuers over the last year or so. In your opinion, have they gone far enough? Do they are there disclosures there making it understandable, and are there any other areas where you'd be keen to see further disclosures or explanation of what's going on?
Yeah, just answering Ed's question there. The difference between TER and ongoing charge, as far as the fund that I run is concerned, is before, ETFs were not included in my TER. So if I held an ETF, it was treated as a security and not as a fund. And the TER of the ETF was not in my fund's TER, and it is now. So that's one difference. Now, I've noticed that my TER has gone up a few basis points as a result of that change, which I think is a positive. In answer to your question, is there good enough disclosure regarding ETFs? I think the answer pretty much has to be no. I like to beat Deutsche Bank up on this on their hedge fund ETF. They disclose a TER all-in charge of 90 basis points, but the 90 basis points excludes the cost, the 200 basis points cost of the hedge funds. It excludes the 2,000 basis points performance fee where applicable, excludes the 50 basis points risk monitoring fee, a 15 basis points index fee which they pay to themselves, and 6 basis points custody fee. It's all sort of wrapped up in the swap charge, which is not disclosed either. And most swap-based ETF providers don't disclose those swap-based charges. iShares do on the odd swap-based ETF they have. Source have started doing that, and I believe Credit Suisse intend to, or may have started very recently to disclose their swap charges, but those swap charges remain undisclosed. Also, you have some pretty heavy trading costs inside ETFs. I read an SEC paper. They estimate that the trading costs average for a large cap US fund on average come to about 1% a year. Commission costs, spread costs, market impact costs, and so on. So there's substantial charges not captured in the TER or the ongoing charges as we progress.
So there, I suppose, you mentioned some kinds of costs that are not disclosed or not in the TER definition. You clearly need to then look at the index itself and how that's put together, and what might be embedded there. But I mean, the underlying trading costs are even in a similar way to we've seen a similar debate for actively managed funds. That's another area I think where people assume that ETFs are passive, but as you point out, some of them are less passive than others.
Well, I think as you get further away from your main deep liquid markets like the Eurostoxx, the FTSE, the S&P, those trading costs will increase, particularly as you get up to things like emerging market bonds in local currency, high yield. Just the cost of entry to these ETFs, the cost of creation is up to 1%, which indicates the trading costs inside those funds. And then, particularly with the fixed income funds, you get quite a lot of churn as bonds mature and they have to be replaced. And that adds to the cost, which obviously doesn't come through in the TER ongoing charge, but could perhaps be captured and disclosed. It might put some people off those markets altogether.
Right. Len, just returning to securities finance for a second and what's been going on there. What trends have you seen? I've heard at different conferences that the overall volumes in the lending market have been pretty low since the financial crisis and haven't really recovered. What impact is that having on the general economics of the business and the motivation perhaps of some issuers to enter the ETF market because they can clearly make some money on the side apart from the TER?
Yeah, I think so. I mean, the level of demand for securities lending has yet to get even close to what it was like prior to the Lehman's collapse. The amount of supply, so the amount of shares, in this case I'm talking more about the underlying shares, say for an ETF, so the actual companies, continues to rise. So we haven't seen people leaving the securities lending market space in terms of what people are making available to borrow. But definitely the amount of demand, and I guess this ties in back what I was saying earlier, that the amount of demand in general for securities lending is still relatively low. Although I think the period just before the Lehman's collapse, we were probably at a normal high. So again, one of the potential drawbacks for ETFs are basically going to use the securities lending space as a way to generate revenue. And again, it depends on what they're holding. Your main market securities, getting a high degree of utilization, i.e., I'm holding 100 shares of a particular stock and I'm lending out 80 of those. It's not going to be very high. So I think the return is going to be relatively low. Having said that, though, depending on how the ETFs have structured their lending arrangements, either through a custodian or their own internal book, they will be able to at least make some money on the assets they're holding. This is an important thing to note, because if they're not in a lending program, then if they're sitting on large amounts of assets, they're not going to be making anything from it at all. At least if they go into a lending program, they'll be making something.
Well, right. Thank you, and Ed, could I ask you, for some big picture stuff? I mean, you pointed out in your slides that fund expenses have managed to increase in Europe over the last 10 or 12 years, despite everybody is aware that the markets are given pretty flat or negative returns over the period. So, are we on the verge of a change in behaviour, or are clever fund structures still going to manage to find ways of charging people in ways that they are not anticipating?
I suppose it's worth clarifying. I'm talking there about retail investors and for cross-border funds across so it's a sort of a pan-European picture. I think for those people that are convinced by the argument of active fund management, then part of that argument is one needs to pay for that service as well. I think and that persists. That's the way the industry works, as it were.
But why then such an obvious lack of economy of scale in the European funds business? You mentioned in US there is some evidence of fund costs going down as funds get bigger, but it seems to
I think
they're missing in Europe.
Yeah, there's two elements as well. One is the total expense ratios I'm showing include the cost of annual distribution fees, or what we call in the UK trail commission. Now, obviously, the UK is gearing up for the implementation of the retail distribution review. So for those sorts of costs, it's likely that those costs will not be appearing in the total expense ratio that we analyse, and so there'll be an impact there. That doesn't mean the end investor pays less, but as far as the costs which the fund are concerned. As far as economies of scale are concerned, it's tricky. I mentioned earlier, some of the largest US funds are much bigger than what you would find in Europe, and obviously there's therefore scope to do this. But it's even the case. I think we've got two factors in Europe. Again, this is for the actively managed side. At one end of the scale, we've got so many funds in Europe. Some of the very smallest ones, run by small asset managers, quite often they'll pass on the back office costs to the investor through an inflated TER. That has an impact on the average. At the other end of the scale, you've got the bigger asset managers that might absorb the back office costs more, but yes, they don't then reduce their management fees even as assets rise even further. But they're almost implicitly are the successful funds. They're the ones that have got huge assets and have demonstrated that their performance has been worth paying for, as it were. And so it's obviously very difficult from a business perspective, from an asset manager, to say, actually, I'm going to forgo some of that, even if retail investors aren't asking me to do so. It will be a sort of an altruistic move, and that's, obviously that's the tricky part, is where would the incentive be for an active asset manager who has attracted those assets, on the back of successful performance. It'll be interesting to see at what level of assets we would have to reach, or what other developments in the industry we would have to see for them to decide to reduce their advisory fees, as it were. We obviously haven't reached that stage yet.
Thanks very much, and I'd like to thank all three of you, Ed, Len, and Peter, for joining a very stimulating discussion, and I'd like to thank all our listeners for participating in today's webinar. And with that, this one comes to an end. We look forward to you joining us in April for our webinar on sector ETFs, and you can find details on the indexuniverse.eu website. Thank you, everybody.